All right, ladies and gentlemen, it is time for a Sofi stock update. Now, here in this video, we're going to focus less on Sofi. We are going to go over everything you guys need to know. But most importantly, I want to give you guys a flash crash alert, kind of like a warning of what could be to come next week, how you guys can kind of position for this to hopefully not lose a lot of money if this does actually happen. Today is a very bad day in the market, so we're seeing a mass panic liquidation. If we go ahead and look at CNBC, you can see even the VIX is up 24.5% today. If you guys are unfamiliar, the VIX is basically the volatility index. Long story short, it takes calls and puts that are being placed on the S&P 500 and it puts it into a chart form. So the higher this is up on any given day, the more puts, the more protection people are getting to the downside, and it's up 24.5% right now. It is still moving around as the markets are dropping here and after hours. This is showing intense levels of fear. Now, maybe they know something that we do not. That's kind of what it would suggest to me right now, but there is a lot of reasons this could be happening. First and foremost, let's dive straight into the reasons. So you have had this divergence between the bonds and the stock market. What I mean by that is the bond rates have been going up, so bond prices have been going down. It works just like a dividend stock. Well, you've seen a lot of analysts, a lot of people questioning, like, why is this divergence so bad? And if we do pull up TLT, that's the best way to actually express this, to put it on a chart form so you guys can see the actual divergence here. The TLT 20-year treasury bond, this thing has been doing pretty much nothing but going straight down here over the last couple of months, whereas the stock market really hasn't been doing that. We went down and we've come back up. The whole time the bond market was pretty much going straight down. This is a divergence. This should not be happening. Typically, stocks and bonds, they do move somewhat similar. If they start to diverge, like stocks going up, bonds going down for an extended period of time, you tend to get like a rubber band snapback type action. And depending how big that divergence actually is, tends to be how big the markets or the bonds will snap back to go into a more normal correlation mode. And I think that's part and part what you're seeing right now. But you also had Fed Mester. She's the Cleveland Fed. She says, Cleveland Fed President Loretta Mester said she's in favor of raising interest rates by 50 basis points, perhaps multiple times, but wouldn't favor going higher than that. Mester called the Fed's pivot from the historically high levels of accommodation during the pandemic era the great recalibration of monetary policy. She said this just today, and the markets actually went up. They literally went up when she says this. So I am not convinced that this move that we are seeing to the downside is actually based off of what she said today. When she started to speak, that was actually right here. That was this rally. Go fact check this if you guys want to. The markets went up when she said that. So I'm not convinced that that's the actual reason why we're selling off right now. Now, we do have earnings coming next week. It's the biggest week of earnings season. Next week, you have Microsoft, Google, UPS, Visa, 3M, GM all on Tuesday. On Wednesday, you have Facebook, PayPal, Ford, Spotify, Teladoc, Qualcomm, Boeing. A lot of big companies right there. Thursday is going to be the main kicker. That's going to be, are we going to hit lower lows on the S&P than we have seen in the past 2 years, or are we going to rally? Are earnings justifying the valuations of these companies? To put this into context, something like Facebook has a 14 price to earnings ratio, right? Something like Apple has a 28 price to earnings ratio. So Facebook book value is about 50% cheaper than Apple. Now, you can make arguments there, but that's the price to earnings multiple for the amount of earnings a company has to how expensive the company is. You're paying 14 times with Facebook, 28 times for Apple. So Apple does have a decent amount of room to come down if they do not impress investors. Same thing for Amazon as well. They're not trading as rich, but what you will notice about that, I said Apple and Amazon, those two companies control roughly 10% of the S&P 500 alone. So if either one of those companies took a big beating on earnings next Thursday, you're going to see the markets come down in a very dramatic way, and that is going to scare everyone. Given the margin rates that we are seeing, given the uncertainty with the Fed and bad earnings, that could be a recipe for disaster, not to mention the bond markets have been getting destroyed. So I think that's what is mostly causing this sell-off right now. Maybe hedge funds, institutions, algorithms, they kind of realize that, hey, earnings are going to be pretty bad. If we get bad earnings at Apple or, Amazon, like I said, you're going to see the markets take a big beating. So we should probably just get out right now. That could be what is causing this move today. There's a lot of things you could actually point to. You also have this that says UN chief to meet Putin next week. Russia declares intent to control Donbass and southern Ukraine. So not good if he controls southern Ukraine and we're not doing business with Russia. About 13% of the world's calories, or about 30% of the wheat alone, comes from Ukraine. They are known as the breadbasket of the world. That is going to really hurt inflation for an extended period of time and even cause food shortage concerns. So there's a lot of reasons why this is actually happening today in the markets. I know people are going to chalk it up to what Fed Mester said, but the markets actually did rally. So that's the one concern I have, drawing a conclusion to that's why we are seeing this drawdown today, because the markets rallied during that. Let me know your guys' thoughts down below in the comment section for why you think the markets are actually selling off. Now, basically the warning here is that you could see that flash crash next week. It could be Facebook. It could be Wednesday, or even Tuesday if Google or Microsoft earnings are bad. Tuesday, Wednesday, Thursday, those are going to be the main days that will confirm if we're going to get this flash crash or not. Obviously, you guys can protect your portfolios by either holding more cash or getting some downside protection to go with it. Either way, fine with me, not a recommendation, but and this is not guaranteed to happen. It's saying, hey, we're probably at like a 50-50 chance right now is what it looks like today. As far as SoFi stock, we actually did hold up very well today relative to other stocks that did take bigger beatings. SoFi was down about 3.18%, $6.39 per share. Yet again, another 52-week low, a new all-time low for SoFi stock. As far as option orders, 15 orders totaling $1.11 million, positive order value of 38%. The short interest continues to climb, now sitting at 20.62%. Cost bar max of 6.56%, utilization of 100%, and the days covered sitting at 3.54. So if you do get this mass sell-off, this flash crash, and that's basically where the markets drop fast, like hard, like a COVID crash, and then come straight back up. That's really what a flash crash is. And if we really do break down under that 410, under the 400 level, it's hard to know where we could actually bottom, but once we do, it would be a sharp rebound back to the upside. At least that's what typically happens. It's kind of like rolling a snowball down a hill, right? But in stock market terms, you start to get margin calls, you start to get mass panic, and then once people are like, okay, this is the bottom, usually you will get people flooding back into the markets. But that's really the main keys to know for the day. As you guys already know from the technical analysis for SoFi stock, it doesn't move around a lot because the stock doesn't move around a lot. But watch that $5 level, especially if we do get a mass sell-off panic liquidation. $9.52 per share. That's going to be the main resistance level if we do get a snapback. If earnings are good next week, you're not going to see a flash crash. Things will be just fine. So keep that in mind. The RSI is now in extreme oversold territory, so we should get a bounce in some form or the other here in the next couple days, couple weeks, but it's obviously not a guarantee. The MACD is extremely bearish as well. So long story short, that is what you guys need to know. Getting straight down to business. If you guys like videos like this one, hit the like button, subscribe to the channel, get your free stocks down below in the description with Webull, Mumu, and Public. Thank you guys for doing that. Also, thinking about starting a Patreon just for a couple bucks a month. If you guys do want to support in that way, help support the channel. Let me know what you guys think about that as well down below in the comment section. Thank you guys for watching, and I will see you in the next one.